Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. This week's topic, guys, is the best indicator for beginning traders, the best indicator for newer traders out there. And to be honest with you guys, I am actually not a huge indicator fan myself personally, but I do understand for new traders, sometimes you lack the experience or lack the confidence and you want a little bit of help. And indicators can be a great help to discern the trend of a stock, etc. However, there are tons of indicators out there, literally hundreds, if not thousands of indicators. So how do you know which is the best one to use? Well, today we're going to talk about that. There's a lot of indicators out there. I mean, MACD, CCI, RSI, stochastics, Bollinger Bands, Keltner channels, on balance volume. My goodness, the list is huge. Now, some of them are more popular than others, okay? But the truth of the matter is there are way too many out there, and it's really hard for new traders to know which one is the good one to use. And to be honest, at the end of the day, and I'm going to talk about that in today's lecture, is price and volume are really the two things you should be most focused on, okay? Price is number one. Price tells us what is happening, higher, lower, neutral prices. Volume tells us how something is happening, okay? Is it happening with commitment? Is it happening with a lack of commitment? So price and volume are always the two most important things that you should be focused on, period, end of discussion. In fact, they're the only two things I have on my charts, but I get it. A lot of people want a little bit of an extra edge because they're not as confident in just price and volume because they might be newer traders. And there's no shame in that game, guys. When I was new, I had the COM channel index on my chart. I had moving averages on my chart. Well, since I've taken both of those off. But today I'm going to talk to you guys about what are some of the better indicators that you guys can use just to help you be a little bit more accurate with your trading. And ultimately, the goal would be to be more profitable with your trading. Okay, so we're going to get into it here just briefly, guys. It's only about a 30 or 40-minute lecture. I think it's very, very powerful because I talk about the 6 or 7 most important things you need to be successful with your trades. And I'm not talking about in the trading business. I'm talking specifically individually for your trades. Hint, hint, price and volume are two of them, but we will talk about moving averages, okay, and how you can apply them to be a better trader. As always, guys, if you like these videos, please click that like button, and more importantly, smash, crush, hammer that subscribe button, guys. There's a lot of great content on this channel. We're going to be changing things up just a little bit. I'll still be doing these awesome weekly lectures, but we're going to continue to add more content. As you guys saw a couple weeks back, we added some more fun stuff in there, and we're going to continue to do that as well. But not in lieu of these great Wednesday lectures. All right, I'm Jared Wesley. Let's get to it. This week's topic is best day trading indicators, especially for beginning traders, but for all traders in general. So we're going to talk about that this week. As you guys know, in general, I am not usually a big indicator fan, but we will go through some of the indicators today and talk a little bit about those. But before we do, don't we always have to just have a little bit of fun and talk about when will the insanity stop? I think we all know the answer to that is never, but it doesn't stop us from enjoying a couple 5 minutes a week of some fun mistakes that other people make. They're not really fun, but you know, we realize that this is going to be an everlasting thing, okay? This week's, in terms of the dollar value, is not that impressive, but it's not the dollar value that we're ever after, whether it's $1 million or $5. It's much more about the principle of the idea, okay? So when you take a look at this week's, again, the dollar value is not the issue. But read this comment. Throughout this journey, right, went all in, by the way, just take a look at that comment, went all in on PRPL. Not ever in your life should you, and I don't care if it's Amazon, you should never go, quote, all in on any stock. So that immediately is the first problem I see right here. Went all in on PRPL. Granted, only a summer paycheck of about $1,000. So clearly this person's not that flush. Took them an entire summer to make this, or somewhat in that range. Throughout this journey of 300% gains and now 100% losses, I held strong, confident there was some actually good DD here, okay?
I won't read the rest because it's just garbage. Now, think about that. You're up 300% and then you lost everything. All right? Everything. So it leaves me a little bit speechless when you think about the lack of common sense that we frequently talk about in the trading industry, but in life in general. Why would you ever go all in on anything? There's one reason: to get rich quick. That's it. Get rich quick, guys. So if you look at this person hasn't clearly learned their lesson. I'll definitely be throwing my next paycheck in here too if I get hired at Kohl's. I'm sorry. That's a problem, right? If you're working at Kohl's as a part-time job, you don't have that much money. And then you want to take that hard-earned money at $9 or $10 an hour, and after a month or two of saving, throw it all in one thing. I mean, just go to Vegas. You're going to have more fun in Vegas anyway, right? At least you get to pick a game and have at least 20 seconds of a good time before you lose all your money, okay? And then somebody finally has a little logic and says, bro, you're supposed to sell before minus 100%. Nah. I was super confident in the earnings report. At this point, I was just trying to break even. Guys, this isn't trading. This is pure gambling. This is basically what I'm getting at. When we do these weekly sessions on when will the insanity stop, it's not about the $1,000 because it's not all that much money. Even to somebody who doesn't have money, it's a lot, but it's not going to break the rest of your life. It's the idea of how people approach this business. They come into this business with unrealistic expectations, overhyped, underfunded, listening to too many Google advertisements of somebody who says, you can turn $512 into $300,000. I did in 47 days. And they believe it. Okay, now maybe this person didn't, I don't know. But the fact that they didn't learn their lesson is what I take as the most egregious thing here. There's two egregious things. One, I went all in. That's never a good idea. And the second thing is I'll definitely be throwing my next paycheck in. If you have that attitude, you're not going to get very far in life, okay? You're not going to get very far in life, okay? All right, let's move on to the important stuff, all right? That's the only one I have for you guys this week, all right? People didn't send me too many of them this past week. This is the only one that was sent to me. So if you have some, send them on in. Indicators. Everybody loves indicators, okay? I don't know what the exact number of indicators is. I just know that there are hundreds of them. Literally, I'm not exaggerating. There are hundreds of indicators out there. And if you don't believe me, these are just some. And these aren't all specific indicators. There might be thousands. They're literally. But these are just some of the ones on TradeStation, okay? Take a look at this for a second. Now, granted, not every one of these, some of these are duplicates like moving average 1, moving average 2, and not every one of these is a traditional indicator. I get that. But there's enough on this list to make your head spin, okay? There's enough on this list to make your head spin. Insert analysis technique and just pick your poison. Again, not every one of these is an indicator, but there's a lot of them, okay? And almost every indicator is based off of price and volume, right? Price and volume. Some of them are based off of time, but almost every one is based on some form of price or volume. And there are lots of them. These are just the ones that are on the TradeStation platform. Now, you could probably find other ones elsewhere. Guys, we've had, I mean, literally, I'm not exaggerating with you. There have been religious indicators in the past. And I'm not talking about indicators for religion. I'm talking about financial indicators based off religious beliefs. Kid you not. Truth, okay? 150 years ago, okay? This is truth. All right, so there's a lot of people that tilt their heads sideways to find that perfect holy grail, so to speak. The next slide here that you see, these are really kind of, in my opinion, some of the more popular indicators, okay? I didn't include, I don't know if you want to consider Fibonacci retracements an indicator. I suppose you could, but stochastics, MACD, com channel, relative strength, Bollinger Bands, on balance volume, moving average. These are, again, not all, but some of the more popular indicators that you see. One of the more popular ones I see recently is the MACD crossover, right? It's a really popular MACD crossover. So there are people out there that use these indicators, and as you saw on the last slide, there are tons of these things. I mean, there's no shortage of indicators. You and I could probably come up with an indicator, right? Whenever it rains outside on the second Tuesday of the third month of the year, and then it crosses over with a relative strength Bollinger Band on volume balance, add a moving average in there, and now you have the Holy Grail, okay? So what's the beef? What's the real deal with indicators? Well, I think most of you guys know I don't like indicators, okay? So the point of this lecture in a lot of ways is to tell you in some ways to stay away from them. And I'm not telling you that all of them are bad. And I'm not saying don't ever use them. This is not what I'm saying. What I'm saying is people put too much weight in indicators. They think there's some special sauce or magic potion in an indicator. There is not. Nothing by itself, nothing in this world standalone is good in trading. You need, what you're going to find out later, are multiple concepts converging, which we'll talk about. I'm getting ahead of myself. But the question is, why are there so many indicators, right? Why do people follow these? Well, new traders lack confidence. Okay, that's one of the main reasons that new traders use indicators. They honestly think there's something special out there, right? There's some holy grail that they're searching for, and they haven't quite found it yet, so they need more indicators. Okay, they lack not only confidence, but they lack knowledge. And because they lack knowledge, they also lack confidence. So these two go hand in hand. New traders, they blindly follow a lot of these furu gurus online because that furu guru is using some type of an indicator. And they go, well, if that person's using it, then it must be the real thing. Okay, new traders are always looking for an edge. You could honestly argue all traders are always looking for an edge. Okay, but what I found from most traders, they don't know their ass from the hole in the wall. All right. New traders have no idea what they're doing. Let's just admit it. And there's no shame in that. This isn't a negative comment that new traders have no idea what they're doing. You really shouldn't have any idea what you're doing if you're new at anything. Okay. It doesn't really matter what it is. If you're a brand new painter, you're probably not that good at it. Right? If you're a brand new, I don't know, bricklayer or carpenter, you're probably not that good at it. If you're a brand new chef, you're probably not that good at it. So there's no shame in saying you're not good at trading. What there is a shame in is doing this and thinking there's anything more to it than garbage, okay? Doing this, give it a second, right? And thinking there's anything more to it than just straight up garbage, okay? This is ridiculous, all right? I'm not even sure if Keanu Reeves in The Matrix could decipher this because I can't. I see a whole lot of mumbo jumbo garbage on here. Now I'm sure there's somebody out there going, sweet, look at that. You don't need this stuff, okay? Right? How did I get a picture of your chart? I mean, I put this one on TradeStation yesterday when I was making this lecture just for fun. Literally, I went up there, I was like, all right, how many indicators can I add here? And I've added, I don't know, 1, 2, 3, 4, 5, 6, and then there's another like 6 on there. There's like 10, 12 indicators on here. I don't know about you guys, but I don't see anything valuable here. So what I'm getting at, guys, and somebody's using the word spaghetti charts, that's the term I use, is it's okay. You have my permission. It's okay to use indicators. You just don't need 10 or 12 of them. Pick one, maybe two, if you really lack confidence. Maybe two. Pick one. Because, guys, take a look at this chart. This is important. This is a chart from yesterday. SQ, a chart that we almost traded yesterday. All right, now take a look at it. Really, take a good look at it. And now I'm going to show you what this chart looks like with none of these things. All right, you ready? I don't know about you guys, but I like this one a lot better. So the last chart you saw is the exact same chart as this. There's nothing different between the last slide I just showed you and this slide. But what I see here, and I blew it up for you a little bit just to show you. I blew this section up. Right where the arrow is, it says entry. I blew it up over here on the left, okay? I see a wide range bar taking out a prior pivot with a narrow range resting bar right at 146, and then I see rippage, which is awesome, okay? That's a 3-bar play. In my opinion, pretty easily recognizable 3-bar play. And over here again, I blew it up so you can see it better. Now let's go back. This is the exact same chart, okay? You just can't see it, right? There's nothing here to see. I mean, sure, you see a little line over the pivot, but all this is crunched and scrunched up your chart, so much that you can't see what's actually happening. Okay, we'll go back, take a look. You can't really see this because there's just too much junk on the bottom of your chart, in the middle of your chart. And note, there's not a single indicator on here, okay? There's price, which are the red and green candlesticks, and there's volume at the bottom. So the price is telling us what is happening. Higher, lower, neutral, higher with commitment. Oh, that's price. That's volume. So meaning what I'm saying is price tells you what is happening, and the volume down here tells us how it's happening. Are we getting price movement with low volume? Well, there's a lack of commitment. If we're getting price movement with big volume, that is commitment, right? It's institutional money that's able to put in 300,000 shares in a 5-minute period on this stock. Okay? No, it's not Reddit users, okay? For all you people out there, ridiculousness. Okay? So price is number one. It tells you what's happening. Price is what forms patterns. Volume tells us how it's happening. And guess what? Every one of those indicators that you guys saw is based off of price and volume. Without price, you can't trade because there's nothing to do. All right? So focus on those core things first. Okay? We'll get to that in just a second. All right? So I put this up here, guys, because the first thing people are going to say, well, geez, Jared, how do you find that stuff? All right. This is a pre-market picture. This is a pre-market picture. Okay. Note, NVIDIA yesterday was number 4 on the dollar gainers list. See up top, it says dollar gainers, 1-day dollar gainers. At the time which I took a picture of this, right around 9 a.m., give or take. Okay. NVIDIA was number 4 on the gainers list. It was up 2.5% and had 248,000 shares pre-market. Market is not open yet. So I just want to take a look. Do you see any indicators on here? The answer is no. You see a 60-minute chart with price and volume. Down here, sorry I cut it off. I wanted to blow it up so you could see it. I apologize. But down here, I see a daily chart that's trending higher. Right? I see an uptrend. Now, guys, I don't know about you, and I understand new traders need a little more help. Do I need any indicator to see higher price highs and higher lows, higher highs, higher lows, higher highs, higher lows? I don't think so. If I look to the left, the stock was trading at 350 and now it's trading at 460. I don't need an indicator to tell me the stock moved up $110. So when I look at the 60-minute chart, what do I see? I see 2 resting days, 2 consolidation days right here that peaked to right around 470-ish. Okay, so it had a big 60-minute move. After a 60-minute move into prior resistance, what would you expect? A consolidation or a pullback. I'll repeat this because this is Trading 101. You see an extended 60-minute chart, bullish 60-minute chart, but it's extended into a prior pivot high. So your expectation is narrow range day or pullback day. Well, it did a little bit of both. The next day, it did the same thing. Why? It's that capitulation. It needs to rest before continuing higher. It just ran a marathon, and now it needs to rest. Well, there's the little dot, pre-market dot, okay? It's number 4 on my dollar gainers. So don't ask me how I found it. It's from the dollar gainers list. Pre-market. Market hasn't opened yet. So this isn't a hindsight suggestion. This is why I'm doing this. There's a method to the madness. It's gapping up. In an uptrend, it's not extended. There's room to go higher. Next slide. This is what NVIDIA looks like after the market opened. All right. This is what NVIDIA looked like after. Now you can see the clean, clear uptrend. There's a daily 200 period moving average, which we'll talk about later on here. But for all intents and purposes, there are no moving averages here. I see a daily that's moving higher. We already looked at the 60. You found it on the dollar gainers chart. And what do we have? A beautiful, beautiful pre-market consolidation. Guys, I've done lectures on pre-market charts, haven't we? Notice I'm putting this all together in one lecture, so pay attention. So we looked at dollar gainers. We found a stock that's gapping over multiple pivots in a consolidation in a clear daily uptrend with great pre-market volume, and it has a pre-market pattern, clean, clear pattern. 930, 933, somewhere around there, stock rips. Now, nowhere in there, this is the key, this is the takeaway, this is the mic drop. Nowhere in there was there an indicator. Nowhere in there was there an indicator. The price formed the pattern. The price formed the gap. Okay? The price formed everything here. And the volume, the only thing the volume does is confirm what we're looking at. See, I don't want to see a stock that has no volume because there's no interest. Stocks with volume have interest, usually institutional interest. I want to follow institutional interest because institutional money is way bigger than you and I. No, it's not Reddit. Okay? Stop reading those articles. So nowhere in here did you just see an indicator. None. So why are you using them? What do you really need them for? The only thing you really need an indicator for is to discern trend. Well, if you want to put a moving average on to help you discern trend, if you want to put a trend line on to help you discern the trend, that's fine. I'm okay with this. But higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher. It's an uptrend. I drew a green line just so you can see. If you need to draw that line to help yourself, fine, draw the line. But why do you need a MACD? Why do you need a COM channel index? What do you need a stochastic for? It's a breakout pattern, for goodness sakes. It's clean and clear as they come. And again, no, this wasn't hindsight. This was on the list in the pre-market. And note, 248,000 pre-market shares. There's some institutional money in this. Takes a lot of money to buy a 248,000 shares of a $470 stock. More money than you have. Follow the institutional money. Okay? That's what it looks like when you do your job right and you choose a proper pattern. None of this crossover Bollinger Band stuff. And again, if you need to use one as a crutch, I'm okay with it. But you'll note, as you get better and better, your charts get simpler and simpler. I'll repeat it. As you get better as a trader, your charts get simpler. Okay? Here it is one more time. One more angle of the same chart. Here's the pre-market. Note that drew the lines. This is pre-market. Pre-market here, pre-market here. Drew the line. Is it really that hard to recognize that consolidation? Is it really that hard? No. It shouldn't be anyway. There's your daily uptrend. So we're not going against the trend. There's your consolidation. It goes from 475 to 495, 497. Rip. But you guys are all back searching for the Holy Grail. You know what the Holy Grail is? Price. Price is the Holy Grail. Volume, you need volume. You got to have volume. Why? The reason you have to have volume is because you need to know if there's commitment in it, and you need to know if there's enough shares for you to trade the stock. There's plenty of stocks with great patterns that don't have enough volume. Okay? Let's do it again. All right? TCDA yesterday. All of these silly indicators on it. Did it give us a good pattern yesterday? Not really, but it's really hard to discern that pattern with all these indicators. But what are you seeing here? You're seeing pullbacks, sloppy ones, I'll agree. A pullback here that bounces, a pullback here that bounces, and then a little bit of a wedge. Now, is this great? No, it's not great. But the point I'm making is this is a lot easier to read than this. I don't even know how you read this. So stop doing it. I understand it's an extreme chart. It's got 10, 12 indicators. I get it. You're going to put one or two on. I get it. But the more indicators you keep overlapping on your chart, the less of you see of what's important. And we have already determined what's important. Price. Price, 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 price is number one. So wouldn't you want to see a chart that shows that the most? Because it's the most important thing you're going to be looking at. So put a chart on there that shows price most prominently. Okay? This isn't rocket science. Okay? Simplicity, guys. You've seen this slide before. I've shown it to you before. Simplicity is the ultimate sophistication. That's it. It's the ultimate sophistication. Somebody's asking about VWAP, volume weighted average price. Yeah, I think VWAP is fine. All right. Taking a stock when it's above VWAP is certainly better than taking one below VWAP. That is fine. Okay. No big deal there. And that's something that's not even on the chart. I mean, you could put it on the chart. I have it on my matrix on TradeStation. Okay. I want to show you a couple trades. Yes, I understand there's a moving average on here. Okay. This again is for the new people, and we'll talk about moving averages in a minute. But what do we have here? A stock on a 60-minute chart that was really extended. You always start with the higher time frame, right? We always do the top-down approach. Start with a daily, then go to a 60, then go backwards. So the 60-minute chart was extended. Look, 1, 2, 3, 4, 5, 6 bars up, and then a gap up. Well, what do you expect when a stock goes from 152 to 160, then gaps to 165 and runs to 167? That's a lot to ask. This stock's put in some work. It needs to rest. There's going to be some profit taking. Okay? There's going to be some profit taking. All right? Pulls all the way back. Chops, chops, chops. But now what do we have? And this is important. Higher low, higher low, higher low. Flat top. We're getting that ascending triangle. Granted, it's coming from a pullback, but a pullback at support. Flat top, ascending triangle. What do we get? Whoa, look at that. 154, it's breaking above the red line. So what's my job? My job simply is find a pattern at 154. If it doesn't give me a pattern at 154, we'll wait. It's that simple. We'll just wait. But if it does, oh man, that's when the stars line up. That's when we trade. For example, somebody today in the chat room was ruing over Amazon. Amazon went higher, went from like, I don't know, 32.90 to 33.10 or something. This was like, I knew I should have taken it. I said, why? Why should you have taken Amazon? It didn't have a pattern. There's tons of stocks that move without patterns. There are tons of them. They happen every single day. We are pattern traders, which means wait for a pattern. If there's no pattern, you don't trade. If you do, you're a gambler. It's that simple. Most traders are gamblers. That's what they are. Admit it. Okay? So, at 154 or 155, somewhere in that area, I would love to see a pattern on NVIDIA. How do I find that? You put it on a thumbnail watch list and you just stare at it. That and 10 other stocks, 15, and you stare at it. And in this case, what happens on the 1 minute? Look at that. It starts out being a 3-bar play, right? But it never triggers the 3-bar play. It ends up being a breakout, right? So you have the wide bar, the narrow bar, and it was going to be a 3-bar play on the 1 minute right there. But it never triggered and consolidated for 3 more bars and another bottoming tail shakeout. Sweet. And then it triggers at 154, gives you an add at 154.45, pulls back and rips and goes up to 156.83 or 156 whatever. Way up there. Think about it for a second. All you did was take a higher time frame, draw your line where the support and resistance is, okay? Higher lows with a flat top. It's a bull triangle or ascending triangle. You know where that support and resistance line is, 154, and anything above it is void, all the way back to 167. You can see it right there. Your job, focus on the lower time frame, wait for a pattern. Focus and wait. Good trading is boring. There it is at 154, rips. You're done, guys. By the way, it depends on what your target is, but in 5 minutes, this stock went $1.50. You had what? 60-cent stop. So it went 2.5 to 1 in 5 minutes. You're done. Your day is over at 9:40. You're going to walk away. You made $100, you made $1,000, you made $5,000. You're done because of the top-down approach. Again, there's not a single indicator on here that you need. Price and volume. There's a reason I'm going through this slowly, to show you don't need the stuff you think you need. You don't need it. It might sell courses for people, right? Ooh, I have the special secret sauce, the MACD crossover with the Bollinger Band at Tuesday at 3:27 in the afternoon. My goodness, the stars line up and money falls from the heavens. It doesn't work that way. You know what works? Good old-fashioned technical analysis with price and volume, because everything's based off those two things. So stop focusing on the ancillary of what the core is. The core is price and volume. Indicators lag. By definition, they lag. So here it is. Wide range bar, narrow range bar, rip. All right, got a little dicey. Wide range bar, narrow range bar, rip. We traded this. You can see it right there. $700 later, $708 later. There it is, Netflix, 345 by 343.25. Why did we give it more room? Well, because there's the wide bar, narrow bar. It got a little dicey, like I said, and then it ripped. Went up to $350. It went $5. Okay, on a $1.75 stop, that's almost 3 to 1. There's no indicator on here. There's nothing on here. Why do you need it? Most traders need them because they lack confidence. So here's the general gist of indicators. Indicators are subjective and usually a crutch for newer traders. They are, let's be honest. They're usually a crutch because you don't have the confidence in recognizing patterns well enough. You think you need some other type of advantage. You don't, okay? Only price and volume are objective, especially price. Price just is, right? Sure, price can be manipulated, but price just is. All indicators are based off of price and volume. Not all, but most. Most, okay? So when you look at this, why wouldn't you just focus on the two things that make everything else possible? The two things that make everything else possible, the things that make a Bollinger Band possible, the things that make a comm channel possible are price and volume. So by definition, price has to lead. So indicators can't happen without price first happening. Follow price. Go to the core, right? It's like Johnny Depp and blow. We're getting middled. Go right to Mexico and get your blow. right? Colombia. Don't let some middleman take you out, and that's what an indicator is doing, okay? I'm not against them. I'm going to be clear about that. I'm against too many of them. That's one of the things I want you to take away from this. I'm not against them. I'm against too many. I personally don't use them. I put a moving average on there from time to time just for the chat room members, but I don't personally use them because I just don't think there's any value in them. But if you need an indicator to show you the trend of a stock or to help you discern the trend of a stock, that's fine. Use one, maybe two on the high side. Okay? So what is important? You ask me, well, if indicators aren't important, I understand we have to focus on price, Jared. You've mentioned that 50 times. I get it. Let's talk about what you should be doing. Okay, what's proper for you to be doing? Multiple concepts converging in an area is what's important. Okay, so a discernible pattern is the first thing you need. A 3-bar play, a buy setup, a breakout, a breakdown, a wedge, a triangle, a climactic, whatever. There's tons of patterns out there, tons of them. But what makes a pattern better? Professional trading strategies tells us pattern boosters make patterns better. Bottoming tails, topping tails, wide range bars, narrow range bars, patterns happening at prior support, areas of support and resistance, retracement levels. If it retraces too much, it's not as strong as you thought. If it retraces too little, it hasn't rested long enough, right? There's value in these things. Change of color bar, balance of power shifting from the sellers to the buyers, increased volume, is it ending volume versus igniting volume? Stock showing good liquidity, meaning enough volume to actually trade it. I see tons of traders. I saw one today. Somebody wanted to take a trade on like a $1 stock or a $2 stock. It had 76,000 shares printed. Well, how are you going to get 5,000 shares of that? You're not. And if you do, you're going to get a terrible fill. Is the stock within its average trading range? Is the stock not up 3 or more bars upon your entry? How many of you out there, admit it, raise your hand, get in stocks frequently that are up 4 or 5 bars in a row? Oh, but it's strong. Sometimes you get away with it, but that's not good trading. That's novice bullshit trading, okay? Is the stock showing relative strength or relative weakness to the market? No, you don't need an indicator for that. Just look at the stock and look at the market. Does the stock look like it's stronger than the market or not? And then market timing is always helpful. Trying to stay with the trend of the market. Yes, are there times on level 1 gaps will go against the trend of the market? Yes, but most of the time you should be trading with the trend. So after getting all of those things in order, then you can look to see if there's an indicator, wait for it, confirming what you're already seeing. So what is an indicator really? It's just one more level of confirmation. After you take the real patterns with the real indicators. The real indicators are based on price, meaning a bottoming tail, that's actual price on a candlestick. Okay? Volume, all right, telling us the commitment level of a stock. Is the stock to extend? These are the things that matter most. Once you have all of these things, then you can look at your indicator and go, all right, does the indicator confirm what I'm already seeing? Which, as you can see where I'm going with this, you don't really need them because you're already seeing all these other things. It's just one more level of protection for you. That's all an indicator really is. If you've done your homework, it's one more level of protection. But don't ever take a trade because you have a MACD crossover and as soon as they cross over, it's a buy signal. It's not. The price on the chart is the buy signal. Period. End of discussion. And these are ancillary things that help the price on the chart be more reliable. That's what we're looking for, reliability. Isn't that what trading's about? Being as reliable as possible. Okay, and then winning more when you win than when you lose. When you win more than when you lose. It's that simple. This is very important stuff, guys. I mean, this is the crux, the core of good trading. I've done a lot of important lectures, and this might be one of the most important lectures I've done because it's telling you to focus on what's really important. What's really going to make you money, and that's price and volume, and then all of the ancillary boosters that go along with it. Once you have these things, sure, if you need 1 or 2 indicators to confirm, fine. But don't put the indicator first, is what I'm saying. Don't put it first. What do we have? Talk to me. We have a stock that's up a ton. What are we getting? Wide range bars, several bars into the move. What are we getting? Increased volume, okay? increased volume, topping tails, doji bars. Look at the daily. Remember, top-down approach, top-down approach. Start with the daily first. Wow, the daily's really extended. It needs a pullback. Great, let's look for a lower time frame pullback. Wow, does it get any nicer than a stock that needs a pullback already and then rips to the moon, has huge ending volume at the top? What are we getting? Multiple concepts converging. A stock that's extended, a stock that has wide range ending bars, a stock that has ending volume, a stock that has topping tails, doji bars, sellers are creeping in. It's time to short this thing. Multiple concepts converging in an area. That's what good trading is. You can look at this moving average all you want, but that didn't make this pattern. Let me repeat that. You can look at this moving average all you want or any other damn indicator. It did not create this pattern. Price created this pattern. Know it, okay? Know where your bread's buttered. Price created this pattern, all right? I mean, you guys, it's unbelievable how many people I see out there pitching indicators. It's unfreaking believable, okay? Here's a stock. Lower high, lower low, lower high, lower low. What do we get? A little bounce off the bottom. It retests the bottom. All right, you want to draw a trend line. Remember what I said? Hey, you want one on there? Okay. We break above the trend line. First indication of a possible trend change. We pull back. We retest but don't put in a significant new low. Second indication of a possible trend change. We break the prior pivot highs. Third indication of a possible trend change. We're now above, remember the 1 or 2 indicators you're allowed to have? We're now above the moving average. Fourth indication of a possible trend change and an actual pattern, a flag, a perfect flag. Wide range bar takes out prior pivots. Narrow range bars here, lower highs, higher lows, beautiful. Where's my CCI? Where's my RSI? Where are my stochastics? Where's my MACD? Are you shitting me? Focus on the damn chart. That's what creates all of those other things you're focused on. And I could do this without the moving average and without the trend line. But if new traders need them, that's fine. You eventually will just visualize these things in your head. Let's try it again. Top-down approach, daily on the stock. It's in an uptrend, okay? Daily stock is in an uptrend. Gapping above the prior pivot high. So over that 55 area, it's good to go. Well, we break above it, and then we pull back to support. Support is not an indicator. This is based on price, okay? So we pull back to support. What do we get? Bottoming tail. What do we get? Volume spike. What do we get? Doji bar. This is beautiful. This is a really nice textbook non-aggressive buy setup. Okay? It's perfect. It's in a daily uptrend. The market is moving higher. It's sitting on a 50% retracement. It's got all 3 location items. Moving average, 50% retracement, minor price support, bottoming tail. Look at the volume. This is good as they come. Moves higher. Consolidation breakout to add, another pullback to add, rip. Where are the indicators? Where's all my indicators? Let's go back for a second. Let's go back. Where are all these bad boys at? Where are all these bad boys at? Why don't I need 15 of these on my chart? I mean, there's got to be something on there that tells me the holy grail. Yes, it's price. And you don't see any one of these that just says price, do you? Not one thing on here just says price. It's crazy. Get your eraser out and erase all these damn things. You don't need them. Okay? You just need price and volume. Multiple concepts converging in an area equals really good trades. My goodness, you guys have seen this one before. What's on this chart? Price and volume. What else do you need? Stock rips higher, pulls back where? Minor price support. Take the top of the pivot, take the bottom of the pivot. It's about a 40% retracement. That's close enough to 40 to 60%. Doesn't give me the big volume of the bottoming tail, but I get several, probably 4 concepts here. There's your buy setup, pulls back and rips. Where are my indicators, guys? Where are they at? Now, I understand that I'm not going to convince all of you. I'm not even trying. I'm just trying to get you to focus on what's really important. There are some of you out there right now that have 15 indicators on your chart, and you're always going to be that way. And that's okay. Just look at your P&L. That's all that matters. If your P&L is massively green, just keep doing what you've been doing. If it's not, you might want to consider dumbing down your charts to become a better trader. Yes, you heard me. Consider dumbing down your charts to be a better trader. Focus on what really matters, okay? Here's another one. Now, is this a great entry pattern? Nope, but it's not the point. I'm showing this chart for a reason, because there are no indicators. Yes, the moving average is there, but again, erase it. Stock's up 1, 2, 3, 4, 5, 6 bars. Huge topping tail, big volume. You're going to get a pullback here. I'm not going to likely short this stock. That's not the point. What I'm trying to get at is this isn't even a good pattern, but I don't need an indicator to tell me it's going to pull back. My indicators are the extended price, the topping tail, and the volume. Those are my indicators. You want to use stochastics, MACD, you do what makes you happy. Okay? It's going to pull back. Next. The only indicator that I respect, the only moving average that I respect, is the 200 period moving average on the daily and 60-minute chart. That's it. They're the only moving averages that I've seen, and don't get me wrong, I'm not speaking for all 11,000 hedge funds. Okay, I'm sure some of them, pick flower blades to pick their stocks, She loves me, well, I don't know. Okay, I don't know why that is not like that. Hold on one second. There we go, that's better. The 200 period moving average on the daily and the 60. Specifically on those time frames, specifically. Okay, this is something you'll actually see professionals using. Okay, when I mean professionals, I mean people on Wall Street, people that manage billions of dollars. They'll actually use the 200 period moving average on the daily. So you see money managers using it. You see hedge funds using it. Hell, you'll even see some people on TV using it. I don't know if that's a good thing or not, but my point is this is something that professionals actually use. Okay, it's a long-term moving average on a relatively higher time frame. So if that is broken, it's a significant thing. We had this conversation yesterday. In fact, when I make the video versions, I'll add it in. My comments from yesterday. For those of you in the chat room, if you remember, 2 people mentioned 2 stocks yesterday pre-market. Here's one of them. You guys remember this from yesterday? VNDA, okay? VNDA was gapping up yesterday. And I said, guys, I'm not putting VNDA on my list. It's gapping right into a declining 200 period moving average. This red line right here, that's a 200 period moving average. You want me to take a look at VNDA? I'll take a look here just in a sec. Man, look at it. It's gapping right to 1250. I mean, the 200 period moving average right at 1264. There's a triple top and the 200s at 1264, and the stock's sitting at 1250. I mean, this is like a perfect example slide for how important the 200 period moving average is. I should probably take a picture of this thing. That's how incredible. You can't take this, guys. All right? I've been telling you this, all the 200s that important. So if they're gapping right into the 200 period moving average, you just simply cannot take it, period. Next. Okay? Normally, if a stock was gapping up to say $14, I would like it because you're gapping over 1 pivot, 2 pivots, 3 pivots, 4 pivots, plus this area, relatively smooth pullback. So you gap up to 14, you have room back up to, anywhere from $16 to $18. But that's not what was happening. This stock was gapping right into the moving average. And I said, no, I will not put it on my list because it's gapping into the daily 200. Hey, I'm just cherry picking. It happened twice though yesterday. And I said it in the pre-market. Wait for it. Oh my goodness, imagine that. Imagine that happening. What happens? Gaps right up into the moving average, and all it does is sell off. Now, is that sell off a lot bigger than I'd expect? Yes, it's way bigger than I'd expect. But the purpose of this is it didn't go any higher. It gapped into the moving average and failed. Completely got spanked. If it gapped to 14, it would have been different. It had enough volume and enough commitment to overcome not only the resistance, but the moving average. It didn't do that, though. It gapped right to it. So to the person, if you're listening, who mentioned this yesterday, this is what happens when you put stocks on your gap list that are sitting at the moving average, the 200 period daily moving average. Okay? Wait. It didn't just happen once yesterday. It happened twice yesterday. I got a lot of people ask me, why isn't KDP on your list? And I said, it's too close to the flat 200 on the daily. It's at roughly $28 right here. See it? This red line is at roughly $28. It's $27.99. Stock was gapping to like $28.50, give or take, okay? And I said, no, there's not only the moving average here, but there's two pivots here. There's a pivot with a bottoming tail here, and there's a pivot with a bottoming tail here, and it's gapping very close to this moving average. The only moving average I respect. And wait for it. I didn't make this shit up. I didn't. This actually happened yesterday. All right, KDP. Again, guys, it's the same thing. Didn't we just go over this one on VNDA? You're gapping right down to what are you at? 28.70, 28.60. The 200 period moving average, the flat 200 is right around 28 bucks. I mean, this is like another perfect picture slide. I should probably take a picture of this one too. I'm gonna probably use this for tomorrow's lecture. Here we go. So yeah, $28, guys, is where the 200 period moving average is, and this stock's gapping like 28.50, 28.70. You just can't take it. All right, you just can't take it. It's probably gonna bounce in this area. We'll have to wait and see till later on. It's probably gonna bounce in this area. Take it off your list. And my comments I made actually happened. And what happened? The stock gapped down right above that 200, right near the pivot, and left a big old bottoming tail and moved higher on wicked volume. Respect the 200 on the daily. So if you're searching, how is this going to help you? If you're searching for your gap list in the morning and you see a 200 period moving average and your stock is gapping right to it, the stock is probably not going to do very much. The 200 period moving average will act as a magnet. I'm not saying it won't ever get through that area. Of course, they eventually get through those areas. But the first day they gap into those areas, they usually don't do much. And if it happens to be a somewhat extended gap, 8, 10, 12%, they almost never do anything. Sure, we can find an exception, but 80% of the time, you'll notice a stock gapping right to its daily 200 MA, the MA is like a magnet. It won't break through that area, okay? Be mindful of those things. It's very, very, very important, okay? And I'm going to end with this. Multiple concepts converging in an area are what make great trades. Multiple concepts converging in an area are what make great trades. Price and volume are what make all of these things possible. Only after getting all of these things, only then can you consider a confirming indicator. One, maybe two of them. You don't need any more than that. I mean, it's just absolute ridiculousness. I mean, it just, when I look at this, I don't even know what to think about it. Right? You take a look and you're like, I'm not even sure. If you're a new trader and you saw this, you would think most traders work for NASA and they graduated summa cum laude from MIT. Because you're sitting there and you're going, options gamma, on balance volume, next third Friday, moving average triangular. What's moving average QEMA? Ooh, stochastic fast. Wow, look at that one. Rate of deviation. My goodness, if you're new in this business, you're probably thinking, man, that sounds like really, really complicated. It must work. Ooh, a Keltner channel. Look at that one. Do you get what I'm saying? They sound like big words. So you're probably thinking, ooh, they must be, somebody super smart must have made that indicator. And because that person's a genius, they must be Warren Buffett. Warren Buffett doesn't use indicators either. The point simply is, why do you? If price is the number one thing everything is derived from, what do you need all this junk for? And again, I'm not against an indicator. I have VWAP on my matrix. Okay, I think it can be helpful. I don't have moving averages, but I would say VWAP is the only thing I really look at, and it's not even that important to me. I prefer my stocks to be above VWAP when I go long and below VWAP when I short. But I'm still more focused on priced pattern charts. Because this, on the left-hand side, this does nothing for me. It does nothing for me. This, however, does. Wide bar, narrow bar, rip. Wide bar, narrow bar, rip. Wide bar, narrow bar, rip. It's a 200 period moving average, and it's a 20 period moving average. Wide bar, narrow bar, rip. This does nothing for me. It doesn't tell me anything I can't already see. Okay? So one last time for you guys. One last time. This is what's important. Focus on this. And as always, because I haven't said it to you guys in a while, always take your stop losses. Not soft mental stops, hard stops in the system. No, High frequency trading machines are not running your stop losses. It might happen 1 out of every 100 trades. It's not a big enough deal for you to care about it. Oh, he doesn't know what he's talking about. I have 15 years doing this. Okay? I do know what I'm talking about. Stop focusing on stuff that doesn't matter and start focusing on things that will actually make you money, like price and volume. You don't need indicators, and if you want to use one, use it as a confirming thing after you've done your homework and gotten the retracement levels, the average trading range, the volume, the bottoming tails, topping tails, all those things. Do it after all that stuff. Okay? So that will do it for this week's lecture. I hope you guys learned a little bit about why indicators are really not that important and what you should really focus on. That's the one thing I want you to take away from this. What you should be focusing on versus what you shouldn't be focusing on. All right? Jared Wesley of Live Traders. We'll get back at it again next week.